Broadcom Inc., 398.95 USD, plus 871, about 2.23% today. The numbers flickering on your screen right now tell a story that goes far deeper than a simple green percentage. As of this exact moment, Broadcom Inc. is trading at $398.95, pushing up by $8.71, or a solid 2.23% on the intraday session. If you are watching the order flow, you are seeing a stock that is aggressively testing the psychological resistance of $400, a level that seemed ambitious just a few months ago but now feels inevitable. The market is currently open, and the volume we are seeing in the last hour suggests that this is not just retail enthusiasm, this is institutional positioning ahead of a critical earnings window. Most investors look at a chart like this and assume they missed the boat, or they attribute the rise to the general tide of the semiconductor sector lifting all ships. That is the expectation, that Broadcom is simply drafting behind the massive wake left by other AI giants, playing catch-up in a market obsessed with graphics processing units. But the reality is significantly more complex and frankly more bullish for those who understand the architectural shift happening in data centers right now. While the broader market is fixated on who sells the most merchant chips, Broadcom has quietly cemented itself as the primary architect of custom silicon for the world's largest technology companies. The expectation is that AI hardware is a commodity race. The reality you need to grasp is that Broadcom has turned it into a bespoke luxury market where they are the only tailor in town capable of stitching together the fabric of the next-generation internet. When you look at the price action today, moving nearly $9 to the upside, you have to peel back the layers of what is driving this momentum. It is not just about the quarterly earnings report looming on the horizon for December 11th. The market is pricing in a fundamental structural change in how hyperscalers like Microsoft, Google, and Meta are spending their capital. Rumors circulating today regarding Microsoft potentially shifting its custom chip business from Marvell to Broadcom are acting as a massive accelerant. If you track Fidelity investments or check the news feed on your Fidelity mobile app, you might see headlines about chip wars. But the nuance here is that Broadcom is winning the war for efficiency. Hyperscalers are realizing that while general-purpose GPUs are great for training, custom ASICs, application-specific integrated circuits, are the gold standard for inference, which is where the long-term money lies. Broadcom is effectively the landlord of this new real estate. Let's pause and look at how the retail and institutional landscape is navigating this move. If you are using Robinhood stock trading features or monitoring your Robinhood app, you are likely seeing a surge in options volume, particularly in calls targeting that $420 strike price for January. The retail crowd, often dismissed as dumb money, has actually been accumulating Broadcom shares steadily since the split, recognizing that the lower share price made it more accessible. However, the heavy lifting today is being done by the types of accounts you would find at Interactive Brokers. We are talking about algorithmic trading desks and hedge funds that use the Interactive Brokers trading platform for its low-latency execution. They are buying the breakout. Unlike the buy-and-hold passive flows you might see in Schwab Intelligent Portfolios or other SoFi robo-advisor products, these active traders are front-running the possibility that Broadcom's guidance for fiscal 2026 will blow past the conservative estimates currently on the street. The divergence between Tesla stock or Apple stock and Broadcom is also worth noting here. While Tesla stock is often driven by sentiment and Musk's latest promise, and Apple stock is a play on consumer hardware cycles, Broadcom is a pure infrastructure play. It is the plumbing. You can't build a modern cloud without Broadcom's networking gear, and you increasingly cannot run efficient AI models without their custom silicon. This makes Broadcom a favorite for Fidelity wealth management clients who want exposure to growth without the volatility of a pure-play AI startup. It is the reason why, if you were to look at Fidelity mutual funds or Fidelity ETFs, you would find Broadcom consistently in the top 10 holdings, often outweighing names that get more press coverage. Let's talk about the business itself, because the narrative has shifted dramatically over the last 24 months. Broadcom was historically viewed as a roll-up strategy, a company that bought aging semiconductor firms, stripped out the costs, raised the prices, and milked the cash flow. That was the old playbook. The Broadcom of today, the one trading at nearly $400, is a different beast. The acquisition of VMware was the turning point. Critics said the $69 billion price tag was too high. They said the integration would be messy. Reality? Broadcom has radically streamlined VMware, transitioning customers to a subscription model that is printing money. The margins on the software side are approaching 86%. This is software-level profitability attached to a hardware monopoly. When you log into your SoFi Invest account or browse investing sites looking for investment help, you often see generic advice about diversification. But consider the concentration of power Broadcom now holds. They control the virtualization layer of the enterprise cloud through VMware, and they control the physical networking layer through their Tomahawk and Jericho switches. This creates a vendor lock-in that is incredibly sticky. If you are a chief information officer at a Fortune 500 company, you're likely writing a larger check to Broadcom this year than you did last year, and you have no viable alternative. This pricing power is what protects the stock from the cyclical downturns that usually crush semiconductor companies. We need to address the elephant in the room: NVIDIA. Every conversation about NVIDIA stock eventually leads to a comparison with Broadcom. The expectation is that NVIDIA owns the AI market, but the reality is that as AI models mature, companies want to reduce their dependence on NVIDIA's high-margin GPUs. They want to build their own chips to run their specific workloads more cheaply. Who do they call to help them design and manufacture those chips? They call Broadcom. We have seen this with Google's TPU. We are seeing it with Meta's MTIA, and the rumors about OpenAI's 10-gigawatt infrastructure build-out suggest Broadcom is the partner of choice there as well. This effectively acts as a hedge. If NVIDIA continues to dominate, Broadcom wins on networking. If companies move away from NVIDIA to custom silicon, Broadcom wins on ASICs. It is a heads I win, tails you lose setup that smart money, perhaps managing funds through Fidelity brokerage accounts or Interactive Brokers stock trading setups, loves to see. Now, I want to interrupt this analysis for a second to get a pulse on where you stand. The market is moving fast and sentiment shifts hour by hour. Comment below how many shares of Broadcom you currently hold, or if you're waiting for a pullback to the 380 level before you enter. It's always fascinating to see the mix of long-term holders versus short-term traders in the comments section. Returning to the intraday action, the price of $398.95 represents a significant breakout from the consolidation range we saw last week. We are seeing higher lows on the hourly chart, which is a classic bullish signal. If you are engaged in self-investing or using online investment tools to manage your own capital, you know that buying at all-time highs is psychologically difficult. It feels like chasing. However, in momentum trends driven by fundamental shifts in earnings power, new highs often beget new highs. The buy low, sell high mantra of online investing often fails when a company is undergoing a re-rating. Broadcom is being re-rated from a slow-growth dividend stock to a critical AI infrastructure growth stock. That multiple expansion allows the stock to keep climbing even if earnings only grow modestly, because investors are willing to pay more for every dollar of those earnings. Let's look at the risks, because no investment is without them. If you are managing your Fidelity IRAs or looking at SoFi active investing options, you need to know the bear case. The primary risk for Broadcom is customer concentration. A massive chunk of their revenue comes from a handful of clients: Apple, Google, and now potentially Microsoft and Meta. If Apple were to successfully design Broadcom out of the iPhone, which they have been trying to do for years with mixed success, that would be a revenue hit. However, the market has largely digested this risk, knowing that the AI data center revenue is growing fast enough to offset any potential weakness in the wireless handset division. Another risk is the macro environment. If the Federal Reserve signals a delay in rate cuts, high beta tech stocks like Broadcom could suffer a temporary liquidity shock. This is where having a diversified approach, perhaps utilizing Schwab Intelligent Portfolios or similar investment help, can smooth out the volatility. But let's look closer at the specific trading mechanics we are seeing today across different platforms. On Interactive Brokers platform, we are seeing tight spreads and massive block trades,